As we enter the last few days left of 2020, all eyes and hopes are on the year ahead after a totally unexpected 7 to 9% GDP contraction this year. A quick CNBC TV18 poll shows that economists expect a 10 to 11% rebound in GDP in FY22. But this double-digit growth will not even bring the Indian economy to the same size it was at the end of FY20, that is the GDP size in March of this year. What thereafter? Do we maintain a 6% growth momentum, or will it be more like the 5% that Morgan Stanley's Ruchir Sharma recently spoke about? Also, what about the other macros in FY22? Will inflation remain subdued as the November numbers seem to indicate? Will credit grow? Will that be the fuel of growth? And what will be the space left for fiscal and monetary policy? Also, more important, will the external world be a drag or will it be a support? For all this, welcome to our show, Outlook 2021. We have four marquee economists to answer all our questions on the economy. Sudipto Mundal, formerly member of the Finance Commission and now with the NCAER. Samiran Chakrabarti, Chief Economist at Citi India. Sonal Verma, the Chief Economist at Nomura. Pranjul Bhandhari, the Chief Economist at HSBC India. Ladies and gentlemen, welcome to the show. Well, as I said, our quick poll is indicating that most economists are expecting a 10 to 11% GDP growth for the next year, FY22. But Samiran, you're the only person who has put out a thorough report. So if you can tell us what will be the propellers for growth? Will it be capex, private consumption, rural, urban, what?
So, Lata, the way we are looking at things is that in the first part of the year, it's the consumption which will have to increase and give the thrust to growth. And this consumption primarily is going to come from, in our view, some form of a forced savings which has happened in the economy, where the actual decline in wages have been much lower than the decline in overall consumption. So that forced savings will give some consumption impetus in the early part of the year. Once that consumption comes into play and supported by vaccine, etc., then in the second half of the year, we could see some improvement in private capex, because the preconditions for private capex, which is low interest rate, relatively higher profitability for companies, the financial leverage of the companies coming down, the thrust from government policies towards these PLI schemes, maybe a bit of the supply chain shift from China. So all these factors can drive private capex in the latter part of the year. So altogether, we think that a 11% GDP growth for FY22 is in the realm of possibilities. But I must add one word of caution, which is that this forecast presumes that the sequential momentum in growth in FY22 will be lower than even what it was in FY20. So the pace of growth is going to be much lower. It's a year-over-year number, which will look better, partly because of the base effect.
Oh, that caution is well taken. We must not run away with our hopes simply because we have this 10 to 11% annual growth, year-on-year growth next year. But, you know, I also noted in your report two things which I wasn't aware of, that wage bill of listed companies actually grew in both Q1 and Q2. We were under the impression that layoffs may have shrunk that bill. You also point out that rural wages have grown. So that again would be a positive, which perhaps is not widely understood. But Sonal, let me come to you on how will the world help or harm growth in India?
In the very near term, next quarter or so, it's more potentially a harm. But as we look out into FY22, it looks like that's going to be a source of support.
Okay.
Very near term, I mean, the virus cases we are seeing in the developed world, we think there is a risk of a double dip both in Europe and US. So that's a near-term headwind potentially for India. But I think taking a more big picture view into FY22, it does look like global growth should be a big tailwind. In 2020, global GDP growth on our estimates contracted by about 3.6%. 2021, we're looking at a rebound to about 5.7%. And even in 2022 calendar year, we are still expecting a plus 4% growth. One big advantage that developed economies have is the pre-ordering of vaccines. So for most of DM world, we think that sort of herd immunity and bulk of the population will be inoculated by the second quarter of 2021. So the fear factor that is currently causing consumption to be weak, because if you look at the supply side and goods side of the economy, things have more or less normalized everywhere. It's really the services and the consumption side where, because of the fear factor, things are still subdued. So as the DM world moves towards greater inoculation by mid of 2021, that should actually be a source of a significant pickup in global demand. So we are actually looking at a synchronized global recovery in the second half of 2021.
My next question is really to what will be the red flags. Dr. Mundal, the informal sector still has taken a very bad hit. And although Samiran's data is showing that formal sector's wage has seen a growth, are we going to see a shrinking of aggregate demand, because 1 year of hit can be very severe for many people?
I must say I haven't looked at Samiran's numbers. But one thing is the absolute growth in the wage bill. The other is the relative share of wages and, if you will, micro enterprise, which are really self-employed type wage workers, against the growth of profits. And if that income distribution has shifted against the lower income, groups, wage earners and micro enterprises and so on in favor of profits, then your propensity to consume is obviously come down. I always look at consumption not as an autonomous factor, but as something that is a derived factor. In developing countries, wealth effects and so on are small. So it's really consumption is a factor of income. The real autonomous drivers are things like government expenditure, investment expenditure, and the external sector. I completely agree with Sonal that I think we are going to get a positive push from the rest of the world, mainly because our shock has been relatively much stronger compared to our trade partners. And also, if you look at the Q2 figures, actually investment is beginning to look up a little bit. So I'm quite hopeful that these drivers will help push growth. I think Shamiran's reference to 11% is very reasonable. I have to caution that, with high frequency indicators, the further down time, further you go ahead in time, the less reliable they become. And if you are using high frequency to look at what will be the growth rate in 2021, you're almost in a zone of guessing. That being said, I completely agree. I was, it will be double digit, but probably not much more than 11%. And that's a very good growth rate. Maybe we come back to it later. I have some thoughts on the fiscal part, but we can talk about that later.
Oh, yes, sure, sir. No, I'm actually straight away coming to it. Pranjul, I'm not coming to you with growth questions. I want to come to you with the inflation question. The latest number is extremely encouraging that we appear to have peaked off. But, the base again becomes adverse when we get to the first quarter, when we come to February, March. But more importantly, commodity prices are giving us a sense that, the global impulses will actually pull up. Even softs, even corn and wheat are rising in global markets. So can inflation put a spanner in the sense that, the Reserve Bank may not be able to be very benign, may not be able to keep liquidity plentiful?
Yes, thank you, Lata. You asked about red flags, and I think inflation is the biggest red flag out there. Now, yesterday's number was benign, and it's going to fall further. I think by January, we'll have CPI inflation at 5. But my worry is that by March, it will become 6 again as the favorable base goes. In FY21, the main driver of inflation was the informal sector disruption. The informal sector produces a lot of essentials, food, clothing, and all of that. And there was a lot of disruption there, and demand hadn't really fallen. I think the driver of inflation in the next fiscal year, FY22, will be different. My worry is that we are going to have to grapple with very high services inflation. Recall between 2007 and 11, services inflation had gone up very sharply, and it had become very sticky and very, very difficult to bring it down. And that was one of the reasons we moved from WPI to CPI inflation targeting, because CPI actually included services. My worry is that once the vaccine is there and a lot of people start consuming high-touch services, then there will be a huge pent-up demand coming up. There's also a link with inequality. As you've mentioned, that large firms are doing better than small firms. But small firms in the unorganized sector employ about 85 to 90% of India's labor force. And because fiscal support has not been very big, we have this huge inequality where the rich are getting richer. Unfortunately or fortunately, the rich consume a lot of services. So that's another reason why, services could see a big increase next year, and we could be grappling with pretty high services inflation, which becomes sticky. So this is a red flag I think we should think about.
Okay. All right. I have to take a break. But my bigger, topic for the discussion today is what will be the post-FY22 growth? I mean, FY22 looks good because of the base. Are we going to be able to maintain head above water? In our case, it will be 6%. Or are we going to slide into 5% because we have killed aggregate demand for a whole host of reasons in the past few years? That question, what is the secular Indian growth rate that we can expect over the next 2 or 3 years? To my guests after this break.